There are a lot of assumptions that need to be made when buying real estate. However, the one thing that we strongly encourage for you to do is to look at the current numbers and just make sure that the investment makes sense at today's numbers. Welcome back to another episode of Keeping It Real Estate. I'm your host, Mike Roeder. And today, if you're a real estate investor who wants to have long-term success, and this is whether you're a passive investor, a general partner, it doesn't matter, today is the episode for you. Today, we're going to review the 6 most important principles that you can use to guide your decision-making to ensure success in your real estate investing career. And before we get started, I just wanted to say thank you so much for tuning in today. We do encourage you to go to the link in the description and join our email list if you haven't already. By subscribing to that email list, you're going to get access to our newsletters, which go out every single Friday with the most up-to-date market insights. It'll keep you up on the market. So thanks again for tuning in. Let's dive into the 6 principles for long-term success in real estate investing. So our number 1 principle is trust but verify. Now, there's a lot of skepticism in the market, and it's a valuable tool in the industry where the goal is often to sell deals. So you have all these brokers out there trying to sell these deals and possibly fluffing up the information. And so, for instance, if a listing broker is claiming that the property has rents that are far below the market, or that the current owner is overspending on their expenses, it's really your job as the active investor to verify that claim with hard evidence. So you want to go into the market and you want to get that primary data. You want to shop the competitor properties. You want to talk to your property manager about the expenses. You want to take a look at the rest of your portfolio and see what the expense ratios are looking like. See what the repairs and maintenance expense is. See what you're paying for utilities. Take a look at the trailing 12, the financials, and understand what their expenses and what their income has been like over the last year or two. And if you're passively investing, you can take a look at some of those numbers as well. You can take a look at the competitors online. Go to apartments.com and figure out if their pro forma rents on the deal that you're looking to invest in are achievable. What are the similar properties nearby charging? What type of finishes do they have in the units? And is it comparable to the property that you're looking to invest in? You want to make sure that you have conservative estimates there. A couple of other tips for passive investors: you could review the expenses on the rest of your portfolio. So if you have other passive investments, that are fairly similar in vintage, maybe in a similar area or a similar submarket, you can take a look at the expenses and, compare that to the property that you're looking to invest in. So again, trust but verify. Our number 2 principle is base decisions on today's number. So in real estate, you've obviously heard the phrase, you make money when you buy. And that is very, very true. There are a lot of assumptions that need to be made when buying real estate. However, the one thing that we strongly encourage for you to do is to look at the current numbers and just make sure that the investment makes sense at today's numbers. So another thing to take a look at is, can the deal cover the expenses, cover the debt payment, cover, any CapEx that's going to pop up over time with the current operations? If you're stepping into a deal and you're negative cash flow by a significant amount day one, that would be a red flag in my book, unless there's a very strong story on how you're going to dig out of that hole. Number 3 principle is cash flow is king. Self-explanatory here. This principle is the bedrock of a great real estate investment strategy. It ensures that each property that you're investing in or that you're adding to your portfolio is positively impacting your portfolio. And that's regardless of market fluctuations. So again, there's going to be a lot of assumptions that go into you purchasing a multifamily property or a single family property or the passive investment that you do with someone else. And you just want to make sure that the property is going to be able to cash flow and going to be able to cover the debt and the expenses, even if you don't get the rent growth that you're looking to achieve moving forward. Number 4, due diligence. Very, very important to execute the proper due diligence when you're buying a deal. And this does not matter what type of real estate you're purchasing. A few things that you want to take a look at. So you're going to be taking a look at the financial statements, and you're going to be doing a physical inspection of all aspects of the property as well. And your team should really be leaving no stone unturned during the due diligence process. And that's really to help you avoid surprises later on and to help avoid stepping into a bad deal. A detailed examination of all aspects of the property can really prevent a lot of future complications and possibly financial losses in the future as well. So a few things that we take a look at, and you should be verifying this information with the sponsorship team that you're investing with as well if you're a passive investor. So due diligence process, typically a 2 to 4 week period. A few things that you're doing: you're verifying the leases, making sure that those leases are correct and that they match up to the rent roll. You're inspecting all aspects of the property, so all the physical attributes of the property: the roof, the foundation, the HVAC system, the chillers, the boilers, the landscaping, the siding, the windows, the landscaping. Again, all of those items need to be taken a look at. And you want to make sure that you have professionals taking a look at those items and giving you professional bids on all of them. You're inspecting 100% of the interior units, or that's at least what our team does, because we want to have a good feel for the condition that the units are in. And then we also want to put together a streamlined, accurate CapEx budget for those interior units. So we want to make sure we know exactly what type of upgrades are in each of those units, and make sure that you're noting that as you go through and you're inspecting these units, or make sure that your team is noting all aspects of those units. You're going to be inspecting 100% of the contracts and making sure that lines up with your expenses that you have projected on the deal. You're going to be doing a utility audit. You're going to be interviewing all the staff members, because you want to make sure that you have A players on your team. And if there's some staff members that might not fit your cut, might not fit your core values, they might not be doing what they need to do or hit on, what they need to hit on, make sure that your team has ads out there and that they have some sort of plan in place to bring on new staff members into the property. And you're going to be reviewing crime reports. There's a significant amount of other due diligence items as well, but those are some of our top items to take a look at when you're conducting due diligence. Number 5 principle is communicate clearly and often. And this is more so on the active side. So maintaining open lines of communication with investors and lenders and your team, your insurance provider, your CPA, it's not just a courtesy, it's a requirement. It is a must. So over communication really ensures that all parties are aligned and aware of the investment status and strategies. As a general partner, you're really in a fiduciary position, and accurate reporting is required. If you're on the passive side, don't accept anything less from the sponsors that you're investing with. Make sure that they're sending you accurate, concise data on a frequent basis. I would recommend at least on a monthly basis. Some sponsors send quarterly. But if you're not happy with the reporting, make sure that you voice your opinion. And better yet, if you can talk to some of their investors before you invest with a new team, ask them what their experience has been like. How is the communication with the sponsors? Ask them for an example of their investor updates, and that should give you a good feel on what the communication is like with that investor that you're looking to invest with. The 6th principle is seek opportunities in a challenging market cycle. Current market conditions have led to an increase in asset sales at compelling valuations. So in the multifamily sector, pricing is down by about 25 to 30% across the nation. And that affords investors with a massive opportunity to step into these properties at a discounted basis. Now, just because you're buying a property at a discount doesn't mean that you're getting a great deal. So you still need to do your due diligence. You still have to have the proper team in place. You still have to put the right debt in place, the right business plan in place, have the right exit strategy, but it allows you a much larger opportunity than looking back in 2021, 2022, and where prices were at. And, Warren Buffett, and you've probably heard this quote a million times before, but when others are fearful, you have to be greedy. And when others are greedy, be fearful. And that rings so true right now because there is a lot of fear in the market. Obviously, pricing has fallen off the map. There's been a decent amount of capital calls, a few foreclosures in the multifamily market, and people are fearful. But that is the time to jump in, is when these prices have come down significantly because there has been some economic turmoil in the multifamily space. Whereas you look back to 2021, 2022, people were greedy. They were jumping into properties and investing into property is because they didn't think that the market was going to go down. And, looking back, today is a much better time to invest rather than in 2021 or 2022. So the cycle has turned, fear is everywhere. Now's the time to invest in secure, great assets at discounted prices, in our opinion. Another thing is institutional capital is starting to come back into the market. Interest rates are likely to stabilize fairly soon, according to the Fed dot plot. And this all bodes well for future values of multifamily deals. So take that into consideration as you're going about your investing strategy, whether you're investing on your own or you're investing with another group. Now, that's it for today's episode. If you have any questions on any of those principles, please reach out. We really appreciate you tuning into this episode of Keeping It Real Estate. If you made it this far, you now have the 6 principles that you can use to guide your decision-making to maximize your real estate investing experience. And if you're not already subscribed, like we mentioned before, make sure to sign up for our newsletter. You can go to granitetowersequitygroup.com, fill out the contact us form. We'll make sure to send you over our free passive investment tracker, our free ebook, and then we'll make sure that you get those newsletters moving forward as well. So thanks again for tuning in. Keep listening to our show so you can become the best real estate investor possible.